Welcome to our guide on venture capital, an exciting world where ideas turn into global businesses. Today, we'll demystify how venture capital works, explore its unique risks and rewards, and show how it powers tomorrow's innovations. By the end of this journey, you'll have a solid understanding of venture capital's role in the business landscape and why it's such a game changer for entrepreneurs and investors alike. Let's dive in by looking at what we'll cover today. Here's what's on our agenda. First, we'll lay the groundwork with an overview of venture capital. Next, we'll talk about how venture capital funds are structured and operated. After that, we'll walk through the investment lifecycle so you see every phase from idea to exit. We'll also demystify essential VC metrics and common terms you need to know. To round things out, we'll look at the major risks and opportunities in VC investing. Finally, we'll wrap up with a quick conclusion on why venture capital matters. Let's start with the basics. What exactly is venture capital and why is it so vital? Venture capital, or VC, is a special type of private equity that fuels early-stage, high-potential startups. Think of it as smart money. Investors provide funding to bold new companies in exchange for an ownership stake. Their big bet? That some of these companies will hit it big, delivering significant returns as they grow or get acquired. But VC isn't just about money. It's an entire ecosystem, bringing together investors, entrepreneurs, and trusted advisors. The real goal here is to spark innovation, helping businesses with groundbreaking ideas move forward even when their resources are limited. It's important to understand that the VC world operates on a high-risk, high-reward basis. While many startups won't make it, those that do can deliver huge rewards, helping drive both entrepreneurship and economic growth. With that context, let's see how venture capital funds are built and managed. Venture capital funds are sophisticated financial engines. They actually start with two types of partners: limited partners, or LPs, like institutions and wealthy individuals who contribute most of the capital, and general partners, or GPs, who do the hands-on work, finding investments, performing due diligence, and actively managing the fund's portfolio. Each fund has a typical lifespan, usually between 7 and 10 years. This isn't a quick win. Capital is invested over several rounds, and results are only clear once the startups are acquired, go public, or otherwise exit. Structurally, VCs pool resources, then invest in carefully selected high-growth startups. Fund managers do the heavy lifting. They find promising businesses, evaluate each one, and assemble a portfolio where some investments will inevitably fail, but others could yield game-changing results. Now that we know the players and how funds are structured, let's explore what the VC investment process looks like and how risks are managed every step of the way. To succeed in VC, it's all about balancing risk with reward, investing wisely while preparing for uncertainty. Networking is crucial here. Successful VC firms build strong, high-quality connections so they spot startups early, share industry best practices, and open doors for founders, linking them with talent, capital, and customers. Once investments are made, robust portfolio management kicks in. Good VCs monitor their companies closely, join their boards, and, when necessary, step in to help steer them back on course, minimizing risk and increasing the odds of success. Investments themselves are structured around clear, staged milestones known as seed, Series A, Series B, and so on. Each round funds growth and only unlocks further capital when progress is demonstrated. But before any money changes hands, due diligence is key. Investment teams thoroughly vet each opportunity, assessing markets, products, teams, and competitors to understand both the upside and the risks. This ongoing diligence, milestone-based investing, and active risk management together make up the heart of successful venture investing. Let's take a closer look at each phase of the VC investment journey. The journey from discovering a startup to ultimately seeing returns unfolds in 4 main phases. First is sourcing. This is where deal flow starts. By drawing on networks, referrals, and in-depth research, VCs identify those rare startups that show real promise and are ready to scale. Next comes diligence. Now, investment teams dig deep, studying the market, vetting the team, running financial projections, and judging whether the business model is truly viable. Once a startup clears diligence, investment happens. Capital is allocated in structured rounds, matching progress to agreed milestones, and entailing negotiations to ensure both upside potential and future protection for investors. Finally, there's the exit. Returns are realized when a startup is acquired, goes public, or otherwise enables VCs and LPs to cash out, sometimes after years of work. At every step, skilled management, smart timing, and proactive support combine to maximize the chances of a big success. Next, how do investors know if their strategy is working? That's where key VC metrics come into play. Mastering venture capital requires tracking the right metrics, so funds stay in control, improve results, and make smarter decisions. Benchmarking comes first. VC funds compare their results against industry peers, looking at things like how long it takes to reach liquidity or how often and how big their exits are. Deal terms are next. These are set out in detailed agreements and protect everyone involved, covering issues like liquidation preferences, ensuring investors get their money back first, and anti-dilution provisions, which shield them if new shares are issued later. Finally, we reach performance metrics. The internal rate of return, or IRR, shows how well the portfolio is doing over time. TVPI, total value to paid-in, tracks how much value is being created relative to what's been invested. DPI, distributed to paid-in, measures how much cash is actually returned to investors. Staying on top of these numbers means investors can maximize gains while keeping risk under control. But every opportunity comes with risks. So let's break down the strengths, weaknesses, opportunities, and threats in venture capital investing. Let's look at venture capital through a SWOT lens, focusing on its core strengths, known weaknesses, opportunities on the horizon, and looming threats. Strengths first. Early-stage deals have exceptional upside for the winners, and by investing in a wide portfolio of companies, VCs reduce the risk that a single failure will sink the whole fund. On the flip side, weaknesses include dependency on the specialized expertise, capital, and networks that VCs provide. Structured, milestone-based funding helps, enabling managers to monitor risk and maintain discipline. Opportunities abound. As the global economy innovates, new sectors are constantly emerging. Think technology, climate solutions, and more, giving VC funds nearly limitless potential to find the next big thing. Yet, the threats can't be ignored. Startup failure rates remain high, which can drag down overall returns. On top of that, bigger macroeconomic forces like recessions can impact fundraising and limit smooth exits. Understanding these dynamics is crucial for any venture investor, so you're prepared for both the rewards and the risks. Now, let's wrap up our discussion with a final thought. Venture capital is truly a catalyst for global innovation and economic growth. By connecting ambitious entrepreneurs with the resources they need to succeed, VC isn't just chasing profits. It's shaping the future. And as we've seen, this industry thrives on risk, resilience, and vision. Thanks for watching, and remember, behind every big idea that changes the world, there's someone willing to invest in its potential.